Recipes for technical trading success in Cook's Kitchen.
Who's the biggest bear on Wall Street? Now, I'm not talking about your average small fund manager who's been bearish since 2010. I'm talking about one of the big bulge bracket investment banks, and that would be Morgan Stanley. Let me tell you a little story here. We're going to go back to mid-April when I wrote this report, Growth Peak on the Horizon, and just showing, hey, coming into Q1 earnings season, we were looking at record quarterly earnings for technology, a record growth rate year over year of 24%, or rather over 20% after the peak of 24% in Q4, and then steadily declining comparables, meaning technology would still be growing, but compared to the quarter a year ago, it wouldn't be growing as fast. So the rate of change was slowing down. But still, technology, huge contributor to the bull market, expected to continue to be one. But some investors who have been long lots of technology stocks for 3, 4, 6 years and have lots of profits, they might want to be booking some of them, give them time to get out of their large positions in case there's any disappointments. Okay, so I also showed you a chart like this looking at the S&P 500. Now, this one's up to date. This chart is as of mid-May here. But back then, Q1, the orange bar, was only projected to see 16% earnings growth for the S&P 500. Look what it actually turned in. It actually came in like over 24% as of today, May 16th. So just phenomenal Q1. But you know the one thing that didn't change was Q2. Right there, 17.6%. These estimates for Q2, the quarter we're in now, did not even budge higher, even after this terrific Q1 we had with just tons of beats and surprises, right? I mean, that's what it would be to go from in early April, we thought Q1 was going to see 16% earnings growth for the whole S&P 500. It actually came in 50% higher at 24%. But none of those great earnings for Q1 changed the outlook for Q2 and moved the estimates higher. So we're at full optimism there, and that also lends itself to the narrative, have we seen the peak, and would make some investors cautious. Okay, I think that's all I wanted to show you there. Up next, let's talk about GDP real quick. So this is an interesting factoid. Q1 will make 7 consecutive quarters of accelerating year-over-year growth in GDP, economic growth. Now, this matches the longest streak since 1948, which occurred out of the 1991 recession. I made this chart on FRED, which is the Federal Reserve Economic Database, via the St. Louis Fed. And so what you want to notice here, since these are the only 2 7-quarter streaks we've had of consecutive growth, is out of the 91 recession, we ramped really high really quick. You go from negative 1% to over 4% in 7 quarters. Contrast that to the current run we're in right now, going from, say, 1.5% up to nearly, we'll call that 2.5%. But anyway, that 7 quarters, we didn't travel very far in the same 7 quarters. So, but this is actually a strength of this economic expansion because it's slow and steady growth, right? Brian Westbury of First Trust has called it the plow horse economy. Now that we're headed towards 3% growth this year, he's dropped. He calls it no longer a plow horse. Something much more powerful. But the idea was, as Kevin Matras here at Zacks aptly put about 3 or 4 years ago, because of this steady 1 to 2% GDP growth that we've had during this whole run since June of 2009, you avoid the booms, which would be followed by busts, right? There's less volatility. So we're not having the boom-bust cycle. We're just having steady GDP growth. That's been great. And we can argue about how supportive the Fed was in creating that, but the fact remains, here we are at seeing record corporate profits and record stock market highs. Okay, moving on. In that April 13th article, I summed up things this way, that peak growth would equal lower returns. If the economy and the earnings are peaking, institutional investors would be looking at selling because they have large positions it takes them several quarters to get out of. And we're late in the cycle, underlined in red there, late in the cycle, interest rates on the rise, big tax reform already priced in, and valuations, not extreme, but, in the upper third of historical averages. Speaking of the economic expansion, that yellow ellipse there I circled, the economic expansion that we're in now has now become number 2 because it exceeded in the 1960s. That one lasted about 105 months, and we just trickled over that. So here we are, and this one is going to be on pace to take on number 1, which was the expansion from 1991 to 2001, 120 months, and by June of this, let's say by the end of Q2, we'll be at 108 months. So who knows if we're going to make it all the way to number 1 without a recession, which is what would kill the expansion, right? Okay, back to here. I gave you my bottom line, April 13th. Not worried about valuations because they are not yet extreme. Bull markets don't die of old age, and they don't die when valuations are where they are now. They die when, the forward PE and the trailing PE are well over 20. Okay, the only caveat I gave there, the last underlined thing in red there, was that we are in the weakest 6-month period that comes only every 4 years. Midterm elections. So historically, they haven't done so good. Then we got all these trade war fears. So these are the things that are sort of weighing on the market. Why, I was extremely bullish in March and April, looking for us to ramp up back to new highs, and we didn't do it. So I started looking around, and this is also part of my process. When I do take a position, like being super bullish, I don't look for evidence to confirm that because I've already done all that homework. Then I turn around and look for evidence to the contrary. And so I found some about less than a week later. On April 18th, I wrote, "Has the stock market topped already? Here come the peak growth calls, and along with them come the stock market top calls." And this one came from Morgan Stanley. Here was what I posted on Twitter. You can follow me at Kevin B. Cook. U.S. stocks may be near a cyclical top, and valuations past their peak, per Morgan Stanley. And here's a quote from them. "There's less reason to behave like it's morning in America than happy hour in America. Markets are closer to the end of the day than the beginning." Okay, some cute phraseology there for the basic idea that they're saying the best times may be near the end. And investors need to prepare for downside as the end of the economic cycle is near, and markets are priced for best case scenarios. So that's when I first became aware of Morgan Stanley as being, taking one of the biggest bearish positions on the street of big investment banks. And on the same day, April 17th, another desk at Morgan Stanley spoke specifically about the tax cuts, saying that there's a downside to fiscal stimulus. And that's because it's already priced in, and it would just be a temporary effect, a temporary boost to consumption. Steve Goldstein from Dow Jones likened it to a sugar high, and the IMF agreed. So you can stop the video, and pause the video, and read the summaries here from Steve Goldstein. But same basic idea came from another desk at Morgan Stanley and the IMF that, hey, tax cuts were just a sugar high. You're going to get a little boost, and that's going to be it. So another reason possibly to be cautious. All right, now we've advanced forward to May 15th. I'm filming this on May 16th, but yesterday, May 15th, Morgan Stanley put out a piece, I believe on Sunday, so probably they released it on May 14th, but it went out to all their clients by Monday. "The end of easy," says Morgan Stanley. So here's this is, and by the way, this analyst, I don't even, let me just step back here. So who do I listen to, right? I listen to CEOs on their conference calls. Now, they're biased to be optimistic, but you want to hear how they're talking about their business. They can't be deceitful or give bad guidance. So if they're giving strong guidance, they are prepared to back it up usually. And they have their pulse on the finger of an industry, which is part of the larger economy. So that's why I listen to CEOs. Here we're talking about investment bank analysts, investment bank economists, and strategists. I listen to them too because they crunch a lot of data. I want to listen to quantitative people. And I'll tell you the third group I listen to coming up in a second. So back to this. I don't know who this investment bank strategist is. His name is Andrew Sheets, who penned this piece, The End of Easy. He was the head of the team who wrote this piece, The End of Easy. But here's their basic idea. 2018 has seen multiple tailwinds of the last 9 years abate. And they think that, we just had 9 years of the markets outperforming the real economy. He says, we think the opposite now applies as policy tightens. And he's obviously referring to Fed policy. So what did Morgan Stanley do? They went to equal weight. And this team he heads is their global asset strategy team. And he thinks we're in a trading range with limited 12-month upside. So that's why they're neutral on equities, going to equal weight. Raised cash just like Goldman Sachs did last week. And what ties in here is BofA Merrill Lynch. They do a great survey, at least monthly, of their institutional clients. And they ask them many things, but one of the things that stood out in the past couple weeks here is they're asking them, what do you think of global growth? At the beginning of the year, 40% of respondents said that global growth would advance, would move higher. Just last week, it was only down to 5% saying that. And I think yesterday, on Tuesday, the 15th, only 1% of BofA Merrill's respondents to their survey said they're optimistic about global growth. So here we go. Here we were losing global synchronized growth. And, is that now a headwind? I actually think, I'm thinking contrary there, that since everybody's so pessimistic on the global economy, whether they're looking at Europe or China, that we're poised for some upside surprises there. And the stock market is giving you room to get in. Okay, last thing on this, the end of easy from Morgan Stanley. These structural headwinds are quite the 1-2 punch. And so for them, regarding the economic cycle, it's raised the risk of a turn that would suggest strategically depressed returns. Which is funny because earlier this year, the bank said that expectations for future returns were at an 11-year low. So we just came off of expectations being very low, probably in February, when the trade wars started to heat up, and now they're basically throwing in the towel. All right. Now, who's the third group I listen to? It's fund managers. Fund managers, okay? Why? Because these are the guys having to put real money to work. Sure, it's not their money, but they love what they do. They have a reputation to keep up. They'd like to keep getting more money. They'd like to take care of their clients. And they've got their own deep research teams. They're looking at companies from the ground up. So again, it's sort of the CEO perspective. Get inside of a business, know it like an analyst, know the industry, then make calls about the economy and your general positioning. One of my favorite managers is Dan Loeb of Third Point. And I mean, this guy is in all kinds, he's heavily in the credit markets too. But here's what he had to say very recently. This is not a time to be rewarded for long market exposure. Whoa, heavy warning there. Market shifts are inherently difficult to anticipate, and when they happen, they do not ring a bell, but they do blow a dog whistle, as we have said in the past. Our job is to listen carefully and to take decisive action when we suspect changes afoot. We believe that the increase in a short book and our reduced net and gross reflect what we are hearing. So Dan Loeb and company are hearing the dog whistle, and they don't like the sound of it. This is a big change for him. I've followed fund managers like him and Andreas Holverson of Viking Global, Steve Mandel of Lone Pine Capital, Mario Gabelli, and David Tepper of Appaloosa. These are smart guys who not only do their homework, but they build research teams with, consistent discipline and a process. And when one of them starts talking like this, now I'm getting a little bit concerned. All right. Oh, and then at the bottom here on this slide, I have Dalio. Ray Dalio has been bearish for about a year, I think. So I'd much rather listen to Dan Loeb. All right. Now, how about some big picture optimism? This is from Shiraz Mian's earnings trends report that's dated May 9th. If you go to the website, look under earnings, look for the earnings trends report, May 9th. I'll link to it in the article that goes along with this video. And you can also get access to the 40-page PDF, which is where I took this chart from. This chart may not be in his short article, but it's definitely in the big PDF. So chart 10, total annual S&P earnings. He's putting a dollar figure on the earnings. Instead of talking about percentage growth or EPS, let's see how many billions or trillions we're making. Remember, it was just before the earnings recession that we topped $1 trillion in profits for the S&P. 2017 finally came back strong. Remember, this is the earnings recession here, no growth. We are in 2018 looking to hit 1.4 trillion in profits. And out to 2020, the estimate is almost 1.7 trillion. Hey, that's real money, huh? And talking about those 2020 estimates, just to break down the big draft horses pulling that wagon, it would be technology, which would be 376 billion of that 1.7 trillion, and the banks, finance, about 370 billion. So, those are the big draft horses there, and they will continue to do that. That's what we're in a strong technology cycle, what I call the technology super cycle, and the banks, boy, they're going to continue to benefit from a steepening yield curve or rising rates and expanding that net interest margin. All right, I think that's all I wanted to show you there. But again, these are estimates, right? Just like percentage growth, these dollar figures are still just estimates. So, but I think it's something you want to keep your eye on, because as long as the economy keeps pumping and so we just 2.3% for Q1, big deal. That's what Q1 has done for 10 years, right? I think Q2 is going to snap back strong, and we are going to get to 3% this year. That's what a lot of the data I looked at is telling me. You follow Brian Westbury, you should definitely get on his blog, get on his mailing list, so you get every economic report he writes up and says, okay, how does this fit into my GDP forecast? And he just got named one of the most accurate for a 2-month period. He had nailed a bunch of reports right on. Okay, all right. Here was my conclusion to my Taser Trader group on Tuesday night. I said, I don't know what 2019 holds, but I'm willing to wager that 2018 has new highs written all over it. And right now, that bet takes this form for me. S&P 3000 before S&P 2400. Okay, so yeah, I'm bullish. And despite Morgan Stanley's claim, and why would you even listen to Morgan Stanley? What if that Andrew Sheets guy, he looks like he's about 30, so maybe he's only got experience in a bull market. But so actually that's kind of rare, because the people with the least experience who've never seen a recession or a bear market would probably be bullish. But the point is that a bank like Morgan Stanley with a deep research team could be influencing hedge funds and sharing research and creating, hey, here is the evidence, here is the thesis for slowing growth and time to scale out of equities. And so that kind of logic could spread. So that's why you want to listen to them. Obviously, it's either, I don't think it's spread to a Dan Loeb, because I don't think he uses Morgan Stanley research. I think he does his own homework. But you're hearing it from two different places. Okay, so why would I be bullish? Because in the short term, I can be agile and nimble, right? I don't own 5 million shares of Micron. I own, let's say, a few hundred or a few thousand. And so I can trade it and step in and out of it and not feel like I'm caught, right? Whereas a big fund manager, they need time to get out of large positions. So if they're a little bit worried and they've got 3-4 years of profits, you know, they've got a double or a triple in a stock, as many do in a stock like Micron, for instance, or NVIDIA. There's investors sitting out there with 200-300% returns in NVIDIA. Good returns in Apple, Alibaba. I still own some Alibaba from over a year ago that I bought at $100. I'm keeping it because I like the long-term growth story there, and I think it's gonna persist past anything that Wall Street traders or the global economy can throw at it. I think that Alibaba will continue to kill it, just like Amazon did. It's the Amazon story all over again. But there are other stocks. Lam Research is a big semi-equipment maker. Applied Materials, another one that large investors have lots of profits in. So if they're getting concerned about trade wars, the tax effect is all priced in, earnings comps aren't going to be as good, then these things are going to make them take profits. I think that's all I had for you today. That pretty much wraps it up. Yeah. So you want to listen to the strategists and the economists. Definitely want to listen to the CEOs on the conference calls. But you also want to pay attention to the fund managers. What are they doing? And starting this week, we just got the SEC 13F filings, where institutional managers have to report their holdings. So you get it 6 weeks after the quarter. So this week was the deadline on Monday. So you're going to be seeing those reports and look over those and see, hey, who were the big sellers in Q1? You know, did they sell during the correction, or were they buying? Now, that's what I want to pay attention to. I don't want to see the ones that got scared out during the February correction. I want to see the ones that were re-upping and buying more. All right, thanks for joining me in the kitchen. I'm Kevin Cook. See you next week.